if, let's say in the worst case scenario, the passive investment income goes forward, then if you're not relying on the passive income as you're working and generating income, would your strategy not be based on building up assets that do not trigger any passive income? And then you build up equity, and then you could borrow against that personally, and then just when you die, you know, your equity in the company then pays off your personal debts, and then avoid the 72%? Could you structure something like that, or?
I think the answer, the question really is, you know, if you don't need the passive income, would you change the nature of your portfolio to reduce the passive income? And the short answer would be, yes, you would, but you want to do it without actually changing your risk. As much as tax matters, it doesn't matter as much as losing money. So you've got to make a decision about keeping that risk profile reasonable and same. And there are ways that that can be done, and we feel comfortable. We know how we want to do that. But the point of these rules are very important. If they pass as planned, any taxable income will eventually, on an integrated basis, be taxed at 72%. So we simply want that number to be zero. And that's not always easy to control. So all things being equal, if I found myself with a situation where I had $25,000 taxable income this year, if I can't do anything else, I'm either going to bonus that out to myself and pay 49% tax in BC because I'm not 72, or I'm going to consider maybe funding a charitable contribution. But in any event, the important thing is this, and this is why you need to separate the passive from the active. Let's imagine I got one company, I make $200,000 a year of active income, taxed at 13%, and I make $30,000 of income taxed at 50%. And I say, no problem, I just bonus out the passive income. You can't do that. When you take a $30,000 bonus, it's going to be deducted against the low rate income. I need these incomes in separate entities. So if your strategy is you're going to use corporate retained earnings to build a long-term portfolio, you're going to need to have them separated if the rules continue to be presented as they have been proposed.